Hi everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you a little something about finance and hopefully help you put more money in the bank. So we're talking, this is video number 2 about Bollinger Bands. And we're going to talk today. Well, please be sure to subscribe or get notifications. We'll be building more and more and more videos through time. If you like them, you can get them sent to you. I look in the notes and at the end of each of the videos, because I will typically put links to websites and the books and things like that. So out there. So we're talking about Bollinger Bands. And what are Bollinger Bands? We said last time, it's essentially a system that takes moving averages and lines them up along a normal distribution. We have +2 standard deviations and -2 standard deviations. And therefore, you have a middle, a lower, and an upper band, the middle band being the average. So it looks something like this when you go. As you can see, or maybe you can't see, but if you look carefully from my settings here, this is a large retailer out there. And you have the Bollinger Band set at 30 days and 2 standard deviations. I talked about that last video as well, and that's an important one because this upper band up here represents 2 standard deviations above this average, and this band down here represents 2 standard deviations below. And what I've done, I've watched this for many, many years out there, what you tend to see is when it gets above the upper band, you tend to have a stock that is trading towards the high end of valuation. And when it gets to the lower band, you tend to have one that's towards the bottom of valuation. Now, I had a good friend at a university in Arkansas that helped me figure this out too. He played a lot with relative strength. Relative strength looks at sort of up and down volume, if you will. We'll have an entire video on relative strength coming up, but basically I combine the two, layer them as I've kind of suggested might work out there, and it actually does tend to work better. So relative strength will show you how to calculate that, but suffice it to say its upper band is a range around 70. And its lower band is a range around 30. So when the Bollinger Bands get above the upper band on the Bollinger Bands and above the upper band on relative strength, it would be a time to sell. So you would have probably actually sold out over here. It didn't get any of the lower bands here, and that's sometimes a bit of a problem, actually. You can change the number of days. We'll talk about that towards the end of the Bollinger Band part, looking at the sensitivity of it out there. The bigger companies out there tend to have less movement, and what we're planning or playing on is the volatility of the stock moving around. That's how we're making money. But ultimately, you can see here, it didn't quite get down to it. It hit another sell signal, and then again down here, which is actually an October time frame here. It did hit a low of about 138 and pop back up. So over the course of this year, you had made some money on this move, which is about 15%. You started the year and ended the year at a very similar price within about 2% of each other. So you made about 10 or 15% on this move over here. And then when you got to this one over here, it was suggesting when you got the relative strength below 30, it just changed it, sorry. When you got the relative strength below 30 here, you little booger. Anyway, and you had the RSI below 30 and the relative strength below the bottom band, you would have actually bought right here and you would have gone from 138 to 152, about a $14 move or about a 10% gain. So you would have done actually a little better than buy and hold, and you would have spent about 9 months of the year in cash, taking no risk at all. So most sites that you go to, and we'll pull up a couple of them like Yahoo Finance and FinViz and so forth, particularly Yahoo, they will preload Bollinger Bands for 20 days. When I first started looking this up when I was at Texas Tech many years ago, I tried 10 days and 20 days and 50 days and 200 days, all the days that were sort of moving averages that seemed to appeal to people. And in the end, 30 days actually worked best. There isn't typically a whole lot of difference between 20 and 30, but there is a difference, and it does make a meaningful return difference. 50 is the next closest to 30, and so forth. So I did have somebody email me. I thought it was kind of interesting. We're going to get to another lecture inside of here on the technical analysis about Fibonacci. It's another number sequence that people look at, and one of the Fibonacci is 34 days. So they wondered if 34 days might not work as well, and that's something I'm going to go back and look at. But anyway, you can set the number of days that you want. I always use 30. Part of why 30 makes sense to me is it's actually trading days. I mean, everybody thinks it's a month, but there's only 22 trading days on average in a month. So it's almost a 6 week time period, which is halfway between earnings announcements. So to me, it kind of makes sense that you're sort of flowing in and around information coming in and out of the market and so forth. So the candlesticks that you see, these individual lines you see right here, are the up and down and the high and the low points of the colors candlesticks. Those are what we're keeping an eye on out there. It's for the current day. If you notice also, I look at it over a 13-month time period. If you can see the bottom, I didn't put it on this chart, but you can see that this is actually a year and a month. There's a lot of seasonality, or tends to be, to companies, and I want to kind of get past that by looking at a little more than a year, but not such a long period as 2 or 3 years. So anyway, the midline is the kind of really important part of it. That is the 30-day moving average. And the reason why I say it's no man's land out there is when it's in the middle of it, from a normal deviation or normal standard deviation out there, it's actually not telling you anything at all. It's actually telling you basically, let me see if this pen will work now. What it's telling you is, you little booger, I'll try that again next time. Anyway, but what it's telling you is, it isn't at the high, it isn't at the low, it's where it's the middle of the distribution. And I can't tell anything about the size kids that somebody's going to have when they're in the middle of distribution and so forth. But the same thing is true. I don't have any probable direction that I can tell you out there. You do see the high and the low as support lines, but you also see occasionally, and I'll pull up one of these too, where it goes up and up and up and up and up and up. And what it will tend to do is come back to that 30-day line and either go as a support line and go back up and then go back up and then go back up, or will tend to hit that one and come back down at lower lows and so forth out there. So just remember that midpoint moves because every single day is another day forward, and you're looking at one day less back, if you will, when you're doing that. So where do you go to get these? I typically use my favorite program is Stock Charts. When you saw the one comment that I just went over, that was actually a Stock Charts graph. You can also get it on Yahoo Finance and to some degree FinViz. I actually pay for Stock Charts and FinViz out there. We'll talk about that later. So what trading rules do I use? Combining relative strength and Bollinger Bands. When it is below that lower Bollinger Band and the relative strength is 30 or less, I actually buy. I sell when it gets above the top Bollinger Band and relative strength is 70 or higher. On the way down, and this is kind of how you save yourself in down markets, if it hits a Bollinger Band, the low, and I buy it, and it keeps going lower, and I get another signal where it's below the lower Bollinger Band and relative strength of below 30, and it's down 10% or more, I will buy again. And if it keeps going down, I will do it again. So I buy a total of possibly of 3 times. When it has to have gone down below the lower band again and the relative strength kicks in. You'll see some examples of this coming up in some of these videos, but I will buy a couple of times. By the time it gets to where it's down the third time, 10% or more, I sell it. Interestingly, at that point, you would be down about 20% on your money, but in the investment world, you want to have some capital to play with tomorrow. So this kind of protects me from the stock that just goes down and down and down and down and down and down and down. When we get to one of the meme stocks, you'll see how important this rule is out there. Anyway, I also use this analysis to help time my options. On the buy side, relative strength of 30 and below the lower Bollinger Band, I start looking at call options. On the put side, we're expected to go down. I actually make relative strength get above 80 in the Bollinger Bands, and I win very, very frequently on those options. I'll show you a couple of examples as we go through that as time as well. So anyway, they do form channels, if you will, around that midpoint price. Best seen visually. Advantages, of course, for Yahoo Finance is it's simple and it's free. For Stock Charts, while it's my favorite, you can do moment to moment, has the most detail. There is a free part of it, but once you get used to doing it, you have to set it up every single time you pull up another graph. So that's why I belong to that one. And FinViz is just a pretty awesome system out there, period. I use it for screening and for fundamental analysis and stuff like that. So anyway, I'm giving you a freebie on the books this time. If you go to this, it is a Bollinger Band strategy. It's a PDF manual. and it's free. You can go down that sucker and check it out if you want. Here, the research gate on Bollinger Bands looks like this. If I go over here, when we pull that one up, it is indeed the content, information content in Bollinger Bands by a couple of different guys out here. And it says this article tests the profitability of Bollinger Bands and technical analysis have found that after adjusting for transaction costs, the Bollinger Bands are consistently unable to earn profits in excess of the buy and hold. However, the profit is improved by using a contrarian strategy. Interestingly, they tested it by not, it's a kind of a tough time period, 94 to 2004, with the dot-com blow-off and that type stuff, and the market up and up and up and up and up at the end of the 90s. They also tested it on indexes and indexes only. The problem with, and it still works, I'm going to pull that up here in just a second, on indexes is the index has a whole bunch of stocks in it. And it's like looking at a whole population of people and getting their average height and then trying to tell what the next person's height is going to be. It'd be a whole lot easier if you could see those 5-foot people to predict shorter than average kids or 7-foot people to predict taller than average kids. When you clump it together into an index, a bunch of stocks, it kind of wipes out some of the volatility. I pulled this up just so you could see it. This is SPY, which is an ETF, but it's an index on the S&P 500 essentially. And you can see that it got towards the high end here, touched the Bollinger Band, the relative strength. You would have sold there. You would have bought here at about 430 or so, and you would have sold when it hit over here at about 430. You would have basically broken even on that one. And then recently you would have bought it down here at about looks like 365, and now it's selling for about 390, so about 25. Overall, you would have made about 6 or 7%, but the person who held over this year started at 420 and is now at 380. They're down about 6 or 7%. I want to expand this out to 2 years to show you something. I can go out and go to 2 years on this and update it, and let's see if it'll update for me. That is being a little booger. I don't know why that's not updating. Anyway, here we go. This is what I was talking about, the trend when it just trends up and up and up and up and up and up and up. The only thing that's going to perform in these type of markets is buy and hold. And you can see that you did hit points in time here and here where you were sold out due to relative strength as well as there and there. So it's more difficult in these up markets, but what they've tended to do, the pattern we traded in 2021 for the people I work with is when it would go to, would come up especially and hit the 30-day moving average, we would put part of our money in, and when it went above, we would sell it. Like here, we would have sold it. We were holding all the way through here. We would have sold it right there. When it came down and hit the moving average again, we bought. When it got up here, we sold. When it hit the moving average again, we bought. When it got up here, we sold. So, of course, then I suppose you could say it burns you in the down markets. But at any rate, when you get these up and up and up markets, the only way to participate is that way. It's just so you can see what this looks like. I pulled up the S&P 500 inside of Yahoo Finance. And then I can go to the full screen there, and I can actually put indicators in over here. And the relative strength does what I want. So it's 14 days, but it uses 80 and 20 when I prefer 70 and 30. And then I save that, and I get a relative strength line down here. And then I add Bollinger Bands. And just like I was telling you before, you tend to get 20 days is the most common. I come back in here and change this to 30. And then I can look and see when it's getting towards overvalued and undervalued and so forth. And like I said, the indexes don't tend to do it as often as the others. And you can see it only hit the sells up at this range up in here. And this is actually over a 5-day period. Let's look at it over 1 year. You can see the index overall for the year went from 4,700 to 3,900, or down about 20%. And you would have bought in there like we talked about and been pretty close to a sell right there, but I probably would have sold over in this range. That's when we essentially broke even on our money from buying over here. But anyway, you can see that you can do it inside of Yahoo Finance as well, but it does not give you near as much information. Anywho, so the strategy and the tip I would suggest this week in this episode is figure out how to use one of the chart programs and play with the number of days. You can go back over here to and change the number of days on the Yahoo one, or it's pretty easy to change it too when you have the SPY one. If I could change, so we go back to 1 year like I did instead of 2. I use 13 months total. You can go in here and change this to 2.2 standard deviations if you want. You can change the relative strength to 12 days, and you sort of are fitting the data to what you're seeing. But you'll see when you do this, it takes forever to update, doesn't it? It's in this mode. Anyway, you can see that it indeed now comes below, as it wasn't quite doing before, and it goes above and it comes below, and you have a little more indications or buy sell points, if you will. And sometimes indexes and stuff work better with 12 days than 14. That's the end of this video. I would appreciate if you guys would, of course, do your emails and so forth to us, comments and suggestions. It's how we keep trying to put stuff up there that is interesting and of interest to you. So have a great day, and we'll catch you guys next time. Thanks.